All right, Bulls and Bears, welcome back with another dose of economic reality. I hope every one of you is doing well. We've got a lot of news to get caught up on here. The economy continues to be manipulated and propped up like we've never seen before. The bad loans on the books of the banks is way beyond what it was in 2008. But what they've done is they've created legislation and they've created ways to allow the banks to remain functional, even though the losses right now are worse than 2008. When you look at the commercial real estate, the politicians, the bankers, they're doing everything they can do to keep this economy operational, right? And the name of the game is to keep the debt flowing, right? Keep people borrowing money. People need to go further into debt increasingly in order to keep the illusion of economic growth alive. So let's get into some news that's going to further prove our point on this in the dire situation of most U.S. consumers here. We've got General Motors out with the following: trouble ahead as loan delinquencies are set to surge. So why would there be trouble ahead? Well, it's because delinquencies are surging higher right around 2020, late 2020, when everybody knows what happened in 2020, right? People lost their jobs. But actually, before 2020, things were getting pretty bad. And in fact, if you look at a chart going into 2020, things were pretty bad. Delinquencies had spiked to over 5%. You can see right here in the chart. Of course, 2020 came in, everything was shut down, stimulus checks, people didn't have to make their payments, rents, car payments, mortgage payments, everything was frozen, stopped. So that allowed the delinquency rate to go down. But look what's happened since then. We're back up to 4.4%. So by this measure, in just a few months, we're going to be where we were before 2020, right? Because again, it was going into 2020, we were up 5% delinquency rate. And when you look back at the financial crisis, 2008, it was only 7, 8% back then. So we were just a few percentages from financial crisis types of numbers. And when people get maxed out on their credit cards, when they can no longer spend, the economy starts to shrink. It starts to deteriorate, right? So the problem right now is we have the high cost of living combined with high debt levels, right? So consumers don't have much more lifeline available. So the politicians, the bankers, they're looking for ways to keep things going. They're looking for easier ways to get people into homes, to get a mortgages. We have 0% down payments are back, 0% down payment mortgages. We have banks still on an emergency measure that came out in 2020 that says they don't have to have any money in reserves to be able to loan that out. They have not been able to take the banks off of that. So of course that still allows the banks to keep on loaning out money, right? So you know the name of the game. So this is something that's going to definitely catch up sooner or later. And I'm thinking there's going to be something big before the consumer fully breaks and before we see a massive surge in consumer bankruptcies and foreclosures and defaults and delinquencies and car repossessions. Before we see that, they're already increasing. But before we see the capitulation of all those things, I think we're going to see something massive that's going to bring the entire economy down. Similar to 2020, could be something different, but in a similar way, shut the economy down completely. I think the banks are going to go down. I think there's going to be a massive compromise of our financial system, maybe even the entire power grid. I think something's going to bring it down because that's the perfect cover for the economic fallout, and it's the perfect cover to come in with trillions of new debt, helicopter money thrown out into the economy. They need an excuse to do that, and I think something big is going to happen here in the next few months, in my opinion. Now, in the meantime, we're seeing headlines like this that makes people think that everything might be just fine, no problem. Federal Reserve's preferred inflation gauge shows price pressures easing further. Now, is that reality? Well, when we look at the number here, we see that prices rose 2% year over year on our last meeting. This was Friday's Commerce Department report. And this is suggesting inflation is not as bad as it was, but prices are still up. So if prices are up instead of down, is that a good thing? Well, it depends on what side of the coin you're on. If you're a business making money from all this, maybe that's a good thing. But if you're like most consumers, 70+%, that's a bad thing. We need prices to come down. We need deflation. But the powers that be, as you probably know, cannot allow deflation. It's the dirty word. It's the D word, right? Deflation. They don't want that to happen because when there's deflation, then the illusion crumbles, right? You need rising prices, inflation to give the creation or to give the illusion of economic growth, right? So when people have to spend more, and yes, they have to borrow money to spend more, that creates what's called economic growth. It's you going into debt is what they call economic growth. It's flawed and it's silly, but that's the real way that they're calculating the numbers. Also, government spending that goes into gross domestic product, and that's chalked up as growth. So this whole model of economic growth, it's very funny the way they do it. I think most of you might know, but for the new watchers, I have to come back to that every couple of weeks to just to remind people the shenanigans that's going on in the way that the economy and the way the growth is being reported. U.S. banks announced dividend payouts after passing the Fed's stress test. Remember, even with more unrealized losses on the books right now than 2008, the banks, according to the Fed, are just fine. There's no problems. So that gave the green light for banks to start handing out more dividends, of course. So the stockholders get rich. And who are most of the people holding the stocks? Well, it's the top 10%. We know that 90% of all stocks in the world are owned by the top 10%. So who's getting richer with these dividends resuming and with the U.S. banks passing the stress test? Well, it's most of the top 10%. That's why we see the wealth continue to grow for the top 10%. And the bottom 90% continue to get further into debt for the most part. Now, I'd say the top 20 to 30%, they may be some of them gaining wealth, some of them treading water, staying even. But we know 70% down, they are getting further into debt. And that's the group also that files bankruptcies and are having the most defaults right now, especially the subprime as you get down to the bottom 10, 20, 30, 40%, which are considered subprime. They're feeling the most pain right now. BRICS is out there with a warning that's been issued by BlackRock. BlackRock issues economic warning at the G7 alliance. Amid the BRICS' continued growth, BlackRock has issued a major economic warning to the G7 alliance as to the debt crisis, right? So we're seeing more and more of these warnings. Will the people collapse first as far as like the consumer? No more debt, no more credit available, can no longer make their minimum payments? Or will it be something else in the system, in the banking system that breaks? Or will it be one of these World War III scenarios that we're already seeing evolve across the globe, that any one of those things, if it turns hot on American soil, that could bring something that brings this down. Will there be an attack like 2001 that brings this down? FDIC adopts new final rule for resolution plans. So these banks, including the big mega banks, they have living wills and how they're going to handle things if the economy crashes and if we see bank runs and if things happen, right? So they are getting leniency right now with the regulations, right? Things have to become easier for money to be loaned out versus getting tighter. That's why we don't see very many banks tightening right now. All right, let's talk about real estate. Housing is one of the biggest things that people watch when trying to figure out what's happening with the economy, and it's one of the biggest things they feel in their pocketbook every month. Obviously, most people, unless you're living with somebody else that's paying the rent or the mortgage, most people have some sort of housing payment they're responsible for. And maybe you're a roommate paying somebody else for your portion of the house. Maybe you're renting a room, whatever it is. Usually some people have some sort of payment. And home prices have remained stubbornly high. We're one of the only channels, maybe the only channel on YouTube entirely telling people since 2020 that the housing bubble was not going to go bust. We knew they were going to do everything they can do to keep this bubble inflated. And of course, we've been right. Now, it doesn't mean that that's going to be forever into the future to infinity and beyond. It just means that we've been right for the foreseeable future. I think it's going to be also propped up. They're doing more things, down payment assistance programs, zero down payment, foreclosure prevention programs, down payment assistance programs across all 50 states. Right? We've talked about these here many times. There's many, many ways that can keep the housing bubble propped up. Zero reserve requirement for the banks. The government buying most mortgages right now. Right? All these things combined create a housing bubble. It's not really deflating unless you look at a few cities now. I guess this would be a positive thing. There's a few cities that are coming down somewhat in their prices. Miami's a big one, down over 11% year over year in the median home price. Denver, number 2, down 6.3%. Seattle, Washington, down 5.5%. Kansas City, Missouri, down 5%. Oklahoma City, Oklahoma, down 4.3%. Tampa, Florida, down 3.2%. Austin, Texas, down 3.1%. Detroit, Michigan, down 3%. Finally, the last two here, San Antonio, Texas, down 2.6%. Raleigh, North Carolina, down 2.6%. So some cities are seeing price declines, and there's many, many smaller cities surrounding those larger cities. So when you look at it, there's hundreds of cities that are declining in price. But when you look at most cities, 95+% still climbing, still going up. The housing bubble hasn't went bust. And some of these price declines, many people would even call this a busting of the housing bubble. So in Detroit, prices down 3%. Would you call that a busting of the housing bubble? No. When people hear busting of a bubble, they want to see big time corrections, 50% plus, right? When you see a housing bubble go bust. And if you took away some of the games that are keeping banks loaning money, keeping home prices propped up, you would see a decline of 70, 80, maybe even 90% in home prices. If we ever went back to a sound system of money where you can't just create endless amounts of money, you would probably see home prices go down 90% just based on that alone, right? So the more money that can be borrowed and conjured into existence, the higher prices are. It's pretty simple. So when will this economy come down? When the supply of money gets shut off, when they can no longer pump trillions of dollars into liquidity into this economy. So your guess is as good as mine when that's going to happen. But in the meantime, let's try to make money off this. I've got a new trade that I just got into yesterday. We're already up 25%. This was a put option against Rivian. And let me just bring it up here to give you the ticker symbol. We're also up on our previous trade before that. And let me tell you here, ticker symbol is RIVN. I went short on this via a put option. Good until September 20th. And that is a $15 put option. So as the price goes down, we're making more. Earlier, I was up 25%. Now I'm up about 20%. So congrats to those of you that followed me on that one. We're winning in our other trade before that. Let me see what that was here. We're still up on NVIDIA. That stock continues to correct. So we're going to continue to look for trading opportunities. I'm going to try to do more of that because I got good feedback from you on this that, instead of just looking at the news, let's try to take advantage of some of the insanity out there in the stock market and the economy in general, right? And as always, continue to stack. I'm still stacking in addition to trading. Do what you can do. People need multiple streams of income. I don't know what I would do if it wasn't for trading. Even with working full time and multiple sources of income, I'm staying pretty cautious here. It's definitely a dangerous environment with this unrelentless inflation, right? Hope everybody's doing well. We're going to wrap it up, and we'll hope to see you back here this weekend. Make sure you are subscribed, please, and come back for more updates. And we'll get through this together and maybe even profit from this. Everybody keep stacking. Bye for now. Peace.